Welcome back to Revenue Margin, brought to you by Rob Malenik. So you're considering that as a business owner that you're thinking about selling. Here's the reality: is most people don't want to hear. Exits don't break at the deal table. They break years before you ever go to market. And what does that mean? Is that I've seen it over and over again when I talk to great business owners. They've built a wonderful organization, they have strong revenue, solid teams. But when it comes time to sell, the outcome doesn't match what you expect the valuation of your company to be versus what you heard in the marketplace. And the question is why? Depending on your how you're treating the exit, it's more like an event rather than a strategy like you've done for investing in your company. A successful exit might take 3, 5, or even 10 years in advance to plan for. It's intentional, it's engineered. It requires looking at your business through a completely different lens than what you were doing when you were initially trying to grow it. Let's start with your foundation. Um, when you're deciding what the definition of win actually looks like, it sounds simple, but I think you, as most business owners, are trying to skip it. Like you almost skip to the valuation. And are you trying to maximize your enterprise value? Are you trying to stay involved in some way, shape, or form and try to keep some value for yourself? Is legacy important? Do you want to keep your culture, your team intact? Are you looking for a clean break and full liquidity? Each one of these kind of requires a different strategy. It requires you to prep your organization for sale ahead of time. And then in addition to that, you're thinking about different buyer types and what they're looking for. You're thinking in advance if they're going to be interested in you. Are they going to be afford you? What is interest rates going to impact them? Or what is they're looking at from a valuation structure? What are they going to look for from you? Which is going to be completely different than if you're selling strategic versus private equity to an individual private owner. If you don't decide your outcome early, you're going to end up negotiating from somebody else's definition of value, which is where you're going to lose leverage. Um, Number two is that I think you're so focused on revenue. As a business owner, it's cash flow, it's about the value generation you have for clients. But when you're selling a business, the financial statements actually become some of the most valuable tools to help explain your value to a third party. It's what they look at the end of the day to decide like future cash flows. They decide if your language, your financials are really the language of trust that they have. What this means is that you're going to have clean, accrual based financials. You're going to have normalized EBITDA with clear add backs. You're going to have predictable revenue streams, reoccurring if possible. If not reoccurring, know that that's going to pull down your valuation. You have strong gross margins and cost discipline, and then your KPIs are very clear and explainable versus what the actual valuation models are supposed to be. If your numbers are inconsistent in some way, shape, or form, your valuation is going to be reduced. The sale process is going to be delayed. You're going to require lots more explanation, and doubt reduces valuation. Ultimately, too, is that you have the third step, which is identifying and eliminating risk before it shows up in diligence and before it shows up in your financial statements. It's where deals fall apart or get overpriced. So common risks I see is like customer concentration. You can't have any one client more than 20% of your revenue. It's key associated with financing. It's key associated with risk. If you have one client, more than 20% of your revenue, your valuation is going to be significantly less than what you want it to be. Your owner dependency. Are you key as a part of the business? Do you have key employee risks without retention plans associated with those employees? You have inconsistent or volatile cash flow that kind of flows where one month you're negative, next month you're positive. That's problematic for most investors. You have weak internal controls or lack of reporting discipline. You have unclear contracts or undocumented processes. Each one of these shows up as a discount in valuations, or worse, a reason for the buyer to walk. The goal is that you're never going to be perfect, and you always might have something like this, but your goal is to identify the risks ahead of time, systematically try to reduce them over a 2 to 3, 5 year period of time, so that when you get there, it is a talking point. But maybe your industry type, it's hard to have diversification. But at least you're prepared for it. You've done your due diligence and you've done what you can to diversify, versus walking into a sale saying, yeah, I got a concentration of 80% and still expecting market. That's going to be doubtful. You need to build that business so it can run without you. This is one of the biggest value drivers that most business owners have a hard time to execute. At the end of the day, the business depends on you for sales relationships, key decisions, operational oversight. Then when you really have is really a high paying job, not really a transferable asset to somebody else. And so strong exits really come from having a stable organization with a clear management team in place that are able to accomplish all those three key things without having to have an investor involved. Having a leadership team, having documented processes, clear accountability. Number 5 is create multiple exit options for yourself, not just one. The worst position is needing to sell to one buyer at one point in time. That really creates, an exit strategy silo that doesn't give you enough opportunity. You want to be able to show value to strategic buyers, private equity organizations, recapitalizations, maybe a minority investment structure. Each one creates a competitive tension, and that tension creates more value for you as a business owner. Number 6 is timing versus the market versus controlling your readiness. Ultimately, you can't control the market. You can only control your readiness to be able to sell. And so interest rates, capital availability, and buyer appetite for your industry type might fluctuate. It's always going to fluctuate. To be honest with you, you shouldn't wait and hope that interest rates are going to get better, because then your industry might have a downturn for some economic reason. So if your business is prepared, you can choose when to go to market instead of being forced into it. But in addition to that, some of these factors that might actually hurt your business because they're going against you, such as interest rates being higher, well, that can be offset because you've got a growing business, your margins are expanding, your risk is low, and as an owner, you don't need to sell. That allows you to hold out for a premium valuation. So ultimately, what does a CFO come in to help you with? A strong CFO isn't just about managing numbers. People look at us sometimes in the wrong way, that we're really there to close the books. We're there to be able to ensure the financials are accurate. Well, that's an important part of the role. The really great CFOs are helping you build a sellable asset and helping drive that valuation for these key factors, and are truly, honestly, giving you feedback for your organization management when maybe you don't want to hear that feedback, or you're like, I think I got a great business, but actually maybe you should do these things, because as an example, you might have too much AR in comparison to your revenue growth, and you might be slipping associated with that. Cash flow is actually extremely important for organizations, and it will dramatically reduce your valuation. So if you're not managing those things, the CFO might point that out and say, hey, versus your industry type, you've actually grown by a significant amount here. And I would actually suggest we need to do this, this, and this to actually improve cash flow. Well, ultimately, what they should bring is strategic financial planning. They should bring visibility to true profitability and value drivers. A lot of times, organizations don't look at what's driving profitability and value drivers for the company. They're identifying risks and value gaps for the organization, and their support in building scalable financial infrastructure so you can be able to grow certain parts of your business where the value is actually there for your company. And they're really bringing prior experience, though, ultimately, from how to sell a company. A lot of organization business owners haven't actually ever sold a company. Myself personally, I've sold $4.7 billion worth of companies over the course of my career, bought and sold them. And so at the end of the day, I have the experience associated with how to do a lot of these things and be able to provide you that strategic guidance. More importantly, we help you run the business like an investor would view it, rather than viewing it just as an operator or an owner where you're trying to maximize profitability for yourself in the short term. So final thought, if you're thinking about selling in the next 3 to 5 years, the time to start is now. You're not when you're tired, not when the business owner, if you're the wife or the husband of the business owner and that person passed away, that's too late at that point. Not when the market is hot and waiting for the market to become hot again. As an example, during COVID, selling pools was extremely hot, and a lot of these organizations loved it. They enjoyed the cash flow, and and then now they want to sell it after COVID when the market is actually down and people aren't buying pools any longer to the same degree. Your time to sell when the market was hot was then, and hoping that that will come back is, you don't know when it might come back again, if ever. And not when a buyer shows up unexpectedly. If you haven't actually planned for the sale of your business and a buyer shows up, you should really step back and say, am I ready to sell? Am I actually leaving money on the table associated with the sale, even if their offer is significantly higher than you think you might be getting? By not talking to somebody ahead of time, you might be actually leaving money on the table by taking that offer because your EBITDA is too low and you weren't planning to sell and weren't prepared for it. So start when you still have time to shape the outcome, because there's a difference between an average exit and a great one. It isn't luck. It isn't timing. It's preparation, it's discipline, and it's taking advice, strategic advice that may be contrary to your short-term benefit. If you want to talk through what I just talked about for your business, or if you want to talk about this further or have additional comments you want to leave in the post below, I would love to hear from you. Thank you once again for joining our episode of Revenue and Margin brought to you by Rob Olenek. I'll see you all in the next one.